into the trading environment or in some other places, and I'll give you some examples in a minute. But also we've got the multinational situation. So we heard discussion of the need for improved rails under which we can do financial transfers or conduct other matters across borders. So how do we respond to that from a governance perspective? And there are lots of challenges there, and we heard some of those this morning. So I'll briefly outline a few of these with specific examples around the consumer data right. And then I'll make a plea for the importance of culture and for approaching things in a way that's more respectful of difference and is not looking to rush to some nirvana and perfection and absolution, because that really is a fool's errand in my view. I've got a brief picture there on the sustainability theme. I thought, well, what can I do to destroy sustainability? I can use an AI, in this case, the Stable Diffusion model, to generate a picture for me because I'm not good at drawing of smokestacks burning data. So it's important in the context of sustainability and knowing that at least 5% of total energy consumption is now out of data centers, and this will increase when we've got more AI and so on, that we don't pretend that these digital data things are happening in the abstract and are not having an impact on our environment, because they absolutely are. Okay, so just a few brief examples of the sorts of horizontal expansion that I was referring to before. We can see that lots of different businesses, not only from banking into non-banking areas, but from non-banking areas into banking, that's happening more and more. A very brief example I've got there is we've got an investor who's come out of software, Atlassian, so Mike Cannon-Brookes, investing through Grok Ventures, his venture capital fund, into a lot of businesses that are more sustainably focused, and also investing into one of the 3 biggest energy companies in Australia, AGL. And he's also a key driver behind the Sun Cable project, which is meant to supply solar energy up into Singapore. So big panels in the Northern Territory, undersea cables, and powering Singapore. So that's quite an ambitious vision. But you can see the thinking here is coming through of, well, hold on, these businesses, they can all be just run much more like data businesses, more like software businesses. And they'll have financial elements, financial services packaged with energy, packaged with telco. So if you look at AGL's byline, they talk a lot about internet and mobile, not just about energy. So this is an example of what I was talking to. This is from 2019, so a piece at the beginning of that year from the Harvard Business Review, suggesting that perhaps we're moving past the Zuckerberg era of move fast and break things. That in order to be sustainable, businesses must pay more regard to the impact of their business models on people. And I think this is fairly incontestable from my point of view. We don't see it fully manifest yet. There's a long way to go from where we are now to that future. But unless we are more mindful of those things, unless we build virtue into products and services, those are less likely to be sustainable. So it just makes business sense to pay more attention to these things. Another point, and we were talking about it across the break, is that really it's very, very difficult now to regulate a product or a service in one domain because of this horizontal spread that we see occurring. I'm a big Venn diagram guy, and I've got a Venn diagram in this slide here. But you can see what I'm trying to get to is that there's lots of interaction between many different areas that previously may have been separate. Issues of privacy, consumer payment, consumer protection, payment systems, cybersecurity, other things. E-safety is another that we might throw into the mix, but there will be many. And most products and services now will cut across multiple regulatory dimensions. So it's very hard to say we've got one size, one regulator fits all, one ring to rule them all and bind them. It doesn't really work that way. So that creates a lot of challenge for regulators in terms of balancing how do we protect consumers while encouraging innovation. And if we look at the discussion from regulators in Australia or Singapore or elsewhere, they're often trying to walk that line. And we heard some of that discussion this morning. So that's a challenging thing to do. And there's an interaction between businesses and states around how that co-regulatory environment is built. So a brief example, Australia's example of open banking is this consumer data right. And its more notable feature is not that it's another open banking regime, but that it has a vision to extend itself and is in the process of extending itself to these other dimensions. So it's moving into energy right now. It will be moving into telecommunications very shortly, into financial services beyond banking. And then, as you'll see later, there's a vision to move it to all parts of the economy. So transport, health, education, government, the whole box and dice. Perhaps even social media. I suggested actually they should move it into social media fast, because that's already where we see big issues, yes, but they're not going there just yet. Quite a complex regulatory model, and you may say, well, that's a bit messy. It sort of is a little bit messy, but there's reasons which I've spoken to why you need many different perspectives at the table in terms of regulation. However, there's a way of viewing this scheme as not necessarily what it's made out to be, which is to empower consumers to make informed choices about which provider that they use, but rather to enable data intermediaries and businesses to get access to consumer data in order to pitch and perhaps nudge consumers into those new products and services. So that's my alternative framing at the bottom there, which is about techno-social nudging, taking off the 2018 book from Re-Engineering Humanity. There is an extent to which consumers are not just rational beings, yes? So in order to get them to change, you not only need to build a system such as this is with low friction in changing, but you might actually need to give them a bit of a nudge. Otherwise, they might not bother anyway, or they may be confused by the choice. So those are some of the points of tension. So there's been heaps of reviews into this, notwithstanding it's only quite a new system. And some of these haven't been released yet. I contacted Treasury recently, and so that statutory review that has been completed recently won't be released for another few months. But you can see they're doing a lot of thinking about how do we iterate, how do we improve this system, what lessons do we learn from banking and take into energy or these other sectors. So I take my hats off to them, and Scott Farrell, I've got up there from Kingwood Mallison, a key driver and architect not only of these reforms, but also of the reforms to our payment system. So there again, we can see people spanning across those regulatory boundaries. So lots more to come here. Interesting to me that from looking at some of the detail, and there's lots of information on this if you want to go looking at it, there is a Data Standards Advisory Committee which publishes minutes. It's evident from the most recent minutes of that committee from July that Treasury is only now really turning its mind to how does it work out whether or not this scheme has achieved its goals, which might be an interesting observation. And they've hired some consultants to assist them in that process, who have compiled a scorecard that might be used over the next coming months and years in order to evaluate the progress of this policy and its implementation in practice. At the moment, there's lots of data about what's available in terms of numbers of providers in the system. I think Nydia's written heaps on this sort of stuff in Singapore and elsewhere, the number of APIs that might be available. But then the real question is, how are consumers using these systems? Yes, and is it making a difference to its undoubtedly good pro-competitive aims? So lots of expansion coming through to enable people to share their data more readily. As I've said before, sectoral expansion into new areas, perhaps nudging people into activity, and acknowledgement that this is not a perfect system, but it is evolving. And so I think there's lots to pay regard to here, lots of lessons to be learned from this type of approach. One example, sort of dear to my heart at the moment, having just come into Singapore for a brief period of time, some of the future uses that might be made of these types of systems. This is an ACCC suggestion as to how some of the location data might be shared and might make things a lot easier for travellers coming in and handling a lot of these things in the background automatically that now at the moment are still a bit clunky for us as we cross borders and try to undertake activities. Also notable, of course, is the recent ACCC action against Google, where they fined Google $60 million for misleading and deceptive conduct in relation to what they say about what they do in data harvesting on location data. Very hard to turn those services off. Two quick points to make on this slide. One is like an information security point, and that is when you're dealing with information security. Down the bottom, we've got there a piece of advice from the CDR saying, oh, don't worry, everything's secure. Having worked in information security, that's not how we think about it. It's more a trust no one environment, yes. So I'm a little bit concerned about that, in that there are risks in these systems, especially cybersecurity risks. But of course, I can understand why government would want to persuade people that this is a lower risk environment. More interesting to me was a recent comment from the head of the Data Standards Board, Andrew Stevens there, where what he did was acknowledge at a RegTech Association event that very quickly, while we may have competition now, there will be massive re-intermediation, and only a few big players will drop out of this with big horizontal offerings and will control the market. So when we think about the aim of this, which is to be more pro-competitive, and then we think about the end outcome, which may be re-intermediation and less competition, to my mind, that takes us back into the sort of space merchants world, where there's only, say, 2 big providers of everything, you know, the sort of oligopoly. And this is really just part of a broader picture of a push here in Singapore and Australia, many other places, to link up data about people and activities across public domains and private domains. And also it ties into issues of digital identity. And that has many different dimensions to it: privacy dimensions, security dimensions. There's an extent, though, to which we need to be careful about a fully reductive approach to this. People are more than just the data about them. We're not like a nice, simple, let's create a digital twin of this person. And people may have very good reasons why they don't want aspects of themselves just bundled up and known to everyone. So it can be a bit dehumanizing if we treat people just in this way. Lots of different frames we could bring to this table, and there are many commentators who do this much better than I. But there are many pre-existing legal frames that we could use here. And we heard the judge this morning talking about the use of common law systems to resolve disputes. Many of our pre-existing legal frames are still relevant here, and all of them have some utility. But again, this is this multi-regulatory picture that we need to come back to. And some emerging ideas around data trusts. Also, administrative law now becomes more relevant. Human rights become more relevant. If you look at the decisions of the Facebook Oversight Board, notwithstanding people may have issues around that and the way it's constructed, nonetheless, it points back to human rights decisions. So we see lots of interesting developments, constitutional developments, even in the context of businesses like Meta. And then there's some simplistic dialogue out there about everything being a zero-sum game. You either have privacy or you have a competitive marketplace. Personally, I don't think that's a productive way to approach it. But at the moment, there's a lot of debate about where those settings should sit. What trends do we see emerging? A shift, perhaps, this is not uniform, a shift from ex post regulation to ex ante. So we can see this in relation to ASIC's new product regulation approach, where for financial services products, they've got to be targeted and pre-approved. We see it also in some of these other changes that I've spoken to. We see a shift in many places from just thinking about data as an individual thing to recognizing it has societal and community elements to it, and that there can be community level damage if we only look at it in an atomized way. We see more human rights issues coming through. We see more of a shift to open standards approaches. We see more recognition of the importance of privacy and security, the need to be restrictive about acquisition of data rather than being highly acquisitive of data, because it creates risks, data breaches. We see them all the time, massive data breaches. Lots of cross-border regulatory cooperation, Australia, Singapore, prime example of that. So the digital economy agreement from a few years ago, but extensive regulatory cooperation between ASIC and MAS and fintech industry cooperation for many years. And that's been built on further with more recent fintech bridge agreements. And I've just clipped a few elements of one of those out here. Lots of commentary from Ross Buckley at UNSW and others about how if people invest more in the regulatory space, in sandboxes, but also into the broader ecosystem, not just sandboxes, they're more likely to get a better outcome when it comes to financial services innovation and appropriate governance. I've also got to commend the RegTech industry associations. I think they do a great job, especially in Australia, in stimulating that debate and looking at the international ramifications. Lots of debate internationally also about the geopolitics. You know, people saying, oh dear, it's falling apart. People are splitting into different camps. And then attempts to draw that back together or frame it from a particular dimension, be that the Quad or something else. But what strikes me is actually that there's a lot of commonality in problems, not necessarily in the detail of the approach, but in the US and China, regulators are struggling with the same things, and they're moving to a more regulated environment rather than a less regulated environment. This is me from 35 years ago, standing not on a fintech bridge, but on a bridge in Changsha in Hunan. And I suppose that perspective, that cross-cultural perspective is really important, that we don't lose sight of that. We don't lose sight of difference. We don't try to erase difference through rapid harmonization that doesn't fit culture. These things must fit culture. They must organically grow. Otherwise, they won't stick. Also, because of the complexity of horizontal business models, we have to be more careful about how we design regulation. In the past, we just designed inside a silo, and I still hear this happening when I listen to regulators designing new pieces of regulation in Australia. They say, that's out of our remit, we're only looking at this, go speak to the privacy people about what's happening with privacy. It doesn't really work that way anymore. People have to be talking across those regulatory boundaries, which does make it a very hard task. Lots of acknowledgement of this in the existing system. So RCEP, and I know Indonesia has just joined RCEP, that contains provisions for staggered implementation. If you look at Chapter 12, e-commerce, there we have 5 and 10-year staggers for less developed countries to come to the table around those programs. My thought also is that we probably need to have different levels of harmonization within regions and globally, so that even if everyone's not in the same place, there's at least a level of harmonization so that certain activities can happen more readily. And this could deal with changes in geopolitics and other things. You could have failover, graceful degradation if you're moving between states, or you could move up a notch. More modularized credentials, so not having everything tied to one identity. Lots of other people have spoken about this, having wallets and different credentials for different applications. And recognizing the sociological context of technology and innovation is critical. So this is really just taking us back to Kranzberg's ideas. From all of this, I'm suggesting that we move from an era of move fast and break things to move slowly and look after relationships. Or if you excuse my super bad Chinese, it might be something like 请你妈你点儿关系最有意思。谢谢。
Thank you very much, Rob, for a fascinating and thought-provoking presentation. We'll come back to some questions later, I'm sure, and the audience in person as well as online will be able to raise questions. For those in person, there's a mic behind you. We can think of a question and you can talk about it during the Q&A. For those online, you can enter your question in the Q&A box, where I'll be able to see and address them to the panelists. Now, the second presentation is by Professor Deborah Healey, and she's delivering a presentation via pre-recorded video. So I'll invite you to watch it right now. Thank you.
Welcome to this session on sustainable banking and the prospects of competitor collaboration. Thank you for joining the session. I apologise for my absence, which was unavoidable, and I can assure you that I am disappointed not to be in Singapore, which is one of my favourite places. In this presentation, I will discuss issues surrounding the opportunities for collaboration on sustainability between competitors in the banking industry under competition regulation, looking briefly at several jurisdictions. I note that I'm preparing an article on this issue, which should be available later this year. Collaboration agreements are quite common in the banking industry because so much of banking practice requires uniformity for interoperability and also because of uniformity for consumer needs. Collaboration is also very pertinent around the fostering of sustainability. But we need to look at this in competition law terms. And in competition law terms, at its most basic level, competition law is based on the premise that creating a level playing field for competition allows the most efficient competitors to supply goods and services to consumers at the best possible prices. However, in competition terms, there is no incentive for individual market participants often to engage in sustainable projects if, for example, costs are raised and they will be at a competitive disadvantage, or where in some other circumstances, like the initiative will not work effectively unless there is buy-in from all or most competitors. Promoting sustainability, therefore, can be tricky in a competition law context. Agreements between competitors, because they are competitors, often have anti-competitive outcomes, which impact the workings of the efficient market which competition law seeks to foster. And particularly behaviours such as price fixing, market sharing, restricting outputs and bid rigging often are termed hardcore cartel conduct by competition laws. And often they are assumed to be anti-competitive. So when a legal action is taken, there is no need to prove anti-competitive impact for the law to actually be breached. They're treated very strictly. So that's why collaborators need to be very careful. Also, other types of anti-competitive collaborations which just have an anti-competitive impact may also be prohibited. Now, competition law is about efficiency, but sustainable initiatives are not necessarily efficient in the short term and may not fit within traditional views of consumer welfare. And also then consumer welfare is notoriously difficult to quantify, but particularly when we're looking at issues like sustainability, where the impact may not be felt for a number of years. But in practical terms, in many cases, collaborations may have overall benefit, which needs to be factored into their assessment. A particular legal system may restrict the consideration which might be given to public benefits, such as sustainability, unless they have exempting mechanisms in the relevant legislation, formal exempting mechanisms which create safe harbours for conduct which might otherwise be in breach of competition laws. In brief summary, competition laws in a state of flux due to the rise of the digital platforms, increasing concentration, and the adoption of competition law by nations with different political economies, legal systems and objectives, and goals and methods are being reassessed globally continually at the moment. Various competition laws permit collaborations in circumstances which might address sustainability, and I will examine some of these laws and policies to indicate ways in which sustainability goals might be supported. And generally speaking, arrangements in relation to sustainability may be considered to have a public benefit, which in some cases may outweigh the detrimental impact of an arrangement on competition between competitors. I will leave the discussion of sustainable banking to others throughout today in the interest of time, but the types of collaborations in relation to banking may include financing green projects, implementing minimum requirements for banking conduct which support sustainability, additional advantages provided to customers for green projects and initiatives, and agreements which will allow more competition in a more risky way to encourage conduct which benefits sustainability. And I hope to expand on that more in my article. So I'll look first at the EU, which has a well-developed competition law, although it's true to say that aside from its prime mandate on the creation of a single market, there's been much discussion of goals and approaches to the economics of competition law over the years. In terms of collaboration, Article 101(1) of the TFEU prohibits any agreements between undertakings, etc., which could prevent, restrict or distort competition. But Article 101(3) requires that allows an exemption for agreements which improve production or distribution of goods or contributes to promoting technical or economic progress while allowing consumers a fair share of the resulting benefit. Now, in general terms, the jurisprudence of the EU courts doesn't oppose the possibility of a sustainability trade-off, but clear guidance on the application of these provisions to sustainability is not comprehensive at this moment. There are some narrow exemptions around standards and environmental goals and reduced pesticide use and animal health and welfare, but there is no comprehensive guidance on sustainability. And the inherent complexity of identifying, measuring and quantifying sustainability benefits and apportioning them to consumers makes it difficult to apply the provisions in the broad sense, as do the sorts of trade-offs that need to be made between static and dynamic efficiency and price and quality, or between the positions of consumers who might be affected differently by the conduct. So, thankfully, there are currently EU discussions centring around a new sustainability chapter in the Commission's guidelines on collaboration. And this is all done against the broader policy agenda of the Green Deal, which was implemented in 2019. And submissions on the draft revised rules were called for in March, and new rules are foreshadowed for January next year. And Margaret Vestager, the EU Commission's Vice President, has stated that they will allow beneficial cooperation in areas like sustainability. So we look forward to the final version of these. I'll just move briefly to Singapore, which is the home jurisdiction of this conference. And I won't say anything that Singapore competition lawyers don't already know, but firstly, I must comment that there's an ASEAN taxonomy for sustainable finance, which will, I know, be the subject of another presentation at the conference. And as an ASEAN member, this is clearly relevant to Singapore. And Singapore also has its own green plan. Under its Competition Act, Section 34 is fairly similar to the EU provisions I've already mentioned, except that the provisions don't contain that requirement that a fair share of the benefits need to go to consumers from the EU provision on which the Singapore provision is modelled. And it's also important to note that Singapore takes total social welfare into account in measuring the impact of collaborations under its provisions, as opposed to using just a consumer welfare approach, which gives it more scope. So sustainability would likely, in some circumstances, fit under the heading of technological or economic progress in relation to the environmental benefits which would accrue from it. Now, the Competition Commission of Singapore, Competition and Consumer Protection Commission of Singapore, as it is now, has collaboration guidelines, guidance on business collaborations. And I think the best outcome in Singapore would be the specific factoring of sustainability into those guidelines, or the creation of sustainability guidelines to show how the Commission will evaluate environmental benefits. I'll now turn to Australia, my home jurisdiction. Australia has well-established authorisation route for Australian business, which allows for exemption on the basis of overriding public benefit, and that's been in our law since 1974. There are two tests. The test for per se conduct in relation to collaboration is that the ACCC, the Australian regulator, must be satisfied that the likely public benefit outweighs the likely public detriment. Or if you're not looking at a per se type of conduct, i.e. not one of those hardcore cartel conducts that I talked about earlier, price fixing, bid rigging, market sharing and output restriction. If you're looking at other anti-competitive conduct, the legal test has two limbs. The proposed conduct would not be likely to substantially lessen competition, or the likely benefit from the conduct outweighs the public detriment. So this authorisation has been in use since 1974, as I said, and it has often been applied to sustainability or environmental issues under the public benefit analysis. And I should at this outset mention the DuPont and Tycor authorisation from 1996, which was the first authorisation which was specifically allowed on the basis of efficiency and environmental impact, but in which I was involved as a lawyer, so it's dear to my heart. But we've been allowing authorisations on the basis of environmental issues since then. Authorisation in Australia requires detailed documents lodged by the parties to the transaction or the proposed transaction, outlining all the issues, naming all the parties. It's not a walkover. You don't automatically get your authorisations. They do get knocked back. And I noticed today even I received notification that a recent agreement in relation to a pay for delay agreement in relation to a patent has just been withdrawn by the parties because they were faced with significant opposition from the regulator. So they withdrew their application. When we look at the question of public benefit in Australia, the ACCC takes a very wide view of public benefit. It looks at total welfare, not just consumer welfare, but it has indicated in past decisions, such as the Qantas authorisation, that welfare benefits which are passed on to consumers will generally be given more weight than those which are just passed on, for example, to shareholders. So in the past, Australia's considered a very large number of banking-related schemes and has authorised them, although there have sometimes been amendments to make sure that they are dealt with in ways which are the least anti-competitive as possible. None of these relate to sustainability, but I just thought I'd talk about a few very briefly so that you can understand that banking authorisations are quite common. So the Australian Payments Clearing Association in 2020 got an authorisation for payment, clearing and settlement systems created by AusPayNet to set minimum standards for conduct and settlement procedures for transactions between banks carried across ATM and credit card networks, including for major credit cards. There was one in 2021 which went till 2022 involving the Australian Banking Association, and it was a COVID relief authorisation. Member banks were allowed to discuss agreeing and giving effect to contracts for the benefit of their customers, with the broad purpose of providing financial relief and assistance to customers during COVID. There was one in 2020, the Financial Services Council, which was really insurers, for member life insurance companies to give effect to a commitment to ensure that healthcare workers are not denied insurance because they're exposed to COVID. And the last one I want to talk about briefly was one by the Australian Banking Association in 2019 to implement the recommendations of the Royal Commission, which we had into banking, about issues such as informal overdrafts, dishonest fees, default interest charge on loans secured to agricultural land, and minimum requirements relating to basic bank accounts. So they were allowed to agree minimum standards on all of those to ensure that there was no race to the bottom and that consumers still were able to achieve these services. Now, in relation to authorisation for sustainability, we have been authorising them for a long time, as I said earlier, and recent authorisations relate to arrangements such as recycling of waste, such as household rubbish, mattresses, food and organic waste. And recently there has been one authorisation granted in relation to funding a sustainable project, which I'll now discuss, and that involved Macquarie Corporate Holdings and others, and it was decided in December 21. So Macquarie is an independent investment bank, and they sought an authorisation in relation to a renewable energy buyers consortium to identify, coordinate and secure a group of buyers to enter into a power purchasing agreement to support the development of a new renewable energy project, which was a wind energy facility in Victoria. And there was a provision in there that if it wasn't that project, it would be an alternative large wind scale farm project in Australia for the buyer group. The buyer group was made up of large and medium-sized commercial and industrial customers with electricity consumption at sites located in Victoria across a diverse range of sectors, including property, manufacturing, health, finance, communications and retail. And that buying group was expected to acquire approximately 50% of the electricity generated by the wind farm for the next 10 years. And of course, that would give it the critical mass to make setting up the wind farm worthwhile. And in terms of markets, they didn't define the markets precisely, but they did note that the combined electricity generated from the project would account from between 2 to 5% of electricity consumption in Victoria and 0.5% to 3% of electricity in the national electricity market, because Australia has a national grid system. So what did the authorisation specifically ask for? What did it specifically seek? Well, they sought approval to jointly negotiate, enter into and give effect to the overarching agreement, jointly discuss and exchange information between buyers, but only relating to the sorts of things which would allow them to facilitate the acquisition of electricity from the project. They wanted permission to individually enter into the main agreement with the developer on the same or substantially the same price and non-price terms and conditions. So to that extent, it was a price fix. Jointly negotiate the financing and transfer of money and energy. And these sorts of things had previously been allowed by the ACCC, where public benefits, including transaction cost savings, promotion of increased competition for supply and environmental benefits existed. And in those cases, there was little public detriment, and the ACCC said there was little public detriment here. The public benefit, the expected reduction of greenhouse gases was by some 2 million tonnes per year, and the Commission said that was a public benefit. So with those strict limitations on the information that could be exchanged, and the undertaking by the parties that the Commission had to be told the final members of the buying group once the term sheet was signed, the ACCC agreed to the authorisation for 14 years, given that the project, all of the negotiations were ongoing, the project would likely only start in 2025, given the need to construct the wind farm. So I think that's a really interesting case, which is very relevant to the issue of sustainable banking. I think that Australia has a very long history of dealing with these sorts of matters, and the flexibility which our authorisation system gives us is very helpful. But not everyone will want the same laws that we have, and I am a regular critic of some aspects of our laws. I'll just give you a summary conclusion then. In summary, what I think you can draw out from this session is that competition laws need to focus on sustainability and to facilitate a range, but not all of the initiatives that competitors want to put up and say are sustainable. Boundaries need to be drawn to ensure that those which are truly anti-competitive don't slip through. They need to be approved in terms that are less rather than more anti-competitive, and they must be able to be weighed up against public benefits. And the benefits of sustainability are likely to be real and urgent in the coming years. Financial collaborations are many and varied. Some are more appropriate than others, and they all need to be considered carefully in this context, and my paper will discuss individual sorts of collaborations in more detail with a more deep analysis of them. There's just not time to do it here. And you know, financial collaborations are really quite common. And I mentioned that in Australia, for example, the ACCC began but discontinued criminal cartel proceedings against banks last year for collaboration in relation to an alleged arrangement about share placement, which was interesting because it apparently was conduct which was not uncommon in the industry, although it wasn't proven. Now, many regulators worldwide are working on this area, and it'll be interesting to see what they all come up with. It'll have to be suitable for their own political economy, the way their competition law works, and the priority which they place on sustainability. I trust I've provided you with some useful information on the topic, and I look forward to finalising my article with my collaborator, Sophia Bai. Thank you for listening.
We're very grateful to Professor Deborah Healey for her presentation. And the next and third presentation is by my colleague Nydia on the use of capital requirements in the transition to a greener economy. Nydia, please.
Thanks. Thanks, Juanjo, for the introduction. Thanks, everyone, for being here today. Well, I'm really looking forward to the discussion on this paper. This is just a work in progress. So I really look forward to hearing questions from you, from Juanjo, from my fellow panelists, or from Robert, because Deborah couldn't make it today, unfortunately. My paper is called, it's about the perils of using capital requirements for the transition to a net zero or the transition to a greener economy. Why do I find this controversial? Or why am I interested in this topic? Well, not so long ago, we started some discussions in policymaking in financial regulation about the importance of transitioning to a greener economy. But when you use capital requirements as a policy tool, I find that type of approach interesting, to say the least, and I'm interested in evaluating the consequences of using that type of part, that part in the regulatory framework applicable to banks and prudential regulation for policy tools outside preventing systemic risks and mitigating systemic risks. Even when you use capital requirements for mitigation of systemic risk, we see some unintended consequences in the economy. So, for example, after the financial crisis, after the global financial crisis, as was mentioned this morning, regulators around the world follow the recommendations by the Basel Committee, the Basel III framework, basically. And this framework raised capital requirements, and we now classify capital requirements and assets in a different way to measure better those risks of those assets and kind of mitigate in a better way with a better assessment in terms of risk management, the risks that can lead to problems associated with systemic risk. The unintended consequences of that approach comes in ways such as affecting the promotion of financial inclusion in certain jurisdictions. So, for example, some years ago, I conducted an empirical study showing with differences how the implementation of the Basel III recommendations in emerging economies raised the cost of loans and limited the volume of loans in those economies. And those economies have a very or pretty much conservative financial system. So they are the banks located there and operating there, if they are not international banks, are very much conservative in the sense of the type of products that they use, the type of risk exposure that they have. But at the end of the day, they had to be better capitalized because of these implementations of the Basel III framework. So if this happens, these unintended consequences in the price of loans in emerging economies happened with a policy tool that was intending to tackle a real problem for the worldwide economy, systemic risk, what would happen if we implement a change in capital requirements to the transition to a greener economy? That's a different goal that kind of falls outside of prudential regulation, or at least what we think that capital requirements are for in the banking sector. So I'm interested in exploring the trade-offs of this policy approach to capital requirements worldwide. And I'm interested in this because this is a very active discussion right now. It's a debate that is happening internationally because the European Union is thinking about this approach and trying to analyze the consequences and the impact of this type of approach for the banking sector. Other jurisdictions have criticized this. Others have not been very vocal about this, but they have been following or implementing other type of approaches to move or incentivize in some ways that banks tweak their capital requirements or their prudential and risk management policies toward a transition in terms of moving towards a green financial system, a greener financial system. So based on this and this active debate in policymaking in financial regulation, I'm mapping in this paper the different regulatory approaches to the problem of the transition to a greener economy or how to tackle climate change by using prudential regulation and these type of regulatory tools. I talk about the trade-offs of this type of approach, more particularly the changes in capital requirements and the possible implications of this, to have a theoretical framework of those potential implications to maybe in a follow-up study to conduct something more empirical as the study that I did for the implementation of Basel III requirements after the global financial crisis. And then I propose, based only on that theoretical perspective and this comparative analysis and the trade-offs of this approach and the different regulatory objectives, I propose some potential solutions to tackle the challenges and those trade-offs that are maybe more challenging for the financial system and the economy as a whole. So as I said, recently, prudential regulators around the world and authorities have begun the announcement of this type of policy and this type of approach to the transition to a greener economy. Perspectives vary, as I said, along jurisdictions and across different prudential authorities. Not everyone has been vocal about this, and the scholarship has been not that active in terms of analyzing these potential consequences, but we are starting to see some papers more from finance scholars and economists about evaluating these potential consequences of this type of regulatory frameworks and this type of proposals. On a global level, we all know that the international standard setting bodies are very important in the discussion of capital requirements and prudential regulation for the banking sector. So the Basel Committee for Banking Supervision, for example, has explored these type of approaches. They have not said anything about changing capital requirements, but they just, they are consulting with the industry and with regulators around the world what to do and what type of policies to use. They just enacted the principles to sustainable finance. So authorities around the world and regulators take into consideration these type of principles, but these are very general, very broad. So we haven't seen yet a very concrete type of recommendation from the Basel Committee on Banking Supervision as the ones we saw after the global financial crisis. We are just in the midst of discussing all these type of approaches. Regardless of this, and even though the Basel Committee hasn't said something specific on capital requirements, some jurisdictions, such as the European Union, is starting this debate and is starting to propose this type of tools, which could lead to something that we are seeing in other areas, in which we see something that has been called the Brussels effect. They proposing something, a regulatory approach, for example, one example that is constantly cited on this is the approach to regulating artificial intelligence or data protection. They, being the European Union, being the first movers, can set a trend in other economies, in other jurisdictions to do something similar. Even if other jurisdictions are not interested necessarily in transplanting this approach, they will be affected, and particularly the financial sector will be affected in other economies because banks operate on a global basis. And many banks are headquartered in jurisdictions that will be affected by the European Union framework if they change in this way the capital requirements framework and this directive, which is under discussion right now. So because of financial conglomerates being affected and one of the institutions in the conglomerate being affected, probably on a consolidated basis, the conglomerate will be affected as a whole, and the economies where they operate will be affected as a consequence. So I'm interested, as I said, in exploring these type of challenges, the trade-offs of these new regulations or these new proposals in the regulatory approach to capital requirements, and to see whether this first is something that will allow us to transition to a greener economy. Secondly, what are the unintended consequences of using this type of policy tool for that? And thirdly, I'm interested in proposing some regulatory solutions. So what is the map of those type of initiatives that are trying to use prudential regulation and particularly capital requirements to transition to a greener economy? The promotional approach and the quantitative approach. So I divide all jurisdictions that I have studied in those two groups. The promotional approach is the one in which regulators are interested in encouraging the financial sector to conduct tests, to evaluate the risks, the climate risks, and how to mitigate those risks, but without promoting a specific approach in terms of capital requirements or without saying something or mandating a specific process to those financial institutions. So it's more like an exploratory phase between the regulator, the authority, and the financial sector. Some countries or jurisdictions that have studied this approach or have implemented this approach are the United States, Singapore, and China. And the quantitative approach is the one that moves toward using capital requirements somehow in the transition to a greener economy or as a policy tool for tackling climate change. Within this group, we have two regulatory approaches. First, the regulators or supervisory authorities that focused on changing the Pillar 1 of the Basel Committee, proposed by the Basel Committee on Banking Supervision. The Pillar 1 is basically the one that tackles or that specifically talk about capital adequacy requirements. This is called in the literature and in these proposals, the brown penalizing factor or the green supporting factor. So it's basically penalizing assets, the investment and the exposure in assets that are considered brown or green. And the other part, the other group within the quantitative approach is the one that is about creating an environment to conduct some studies and some scenario-based climate risk measurement with exercises based on specific scenarios, very similar to what happened with the stress testing, to assess how, in terms of risk management, the companies or financial institutions need to change their capital to meet those risk management policies and to adequately consider themselves solvent in terms of the exposure they have to certain assets or to certain risks that are considered risks related to climate change. This is affecting the Pillar 2 of what we know about the Pillar 2 in the Basel Committee on Banking Supervision recommendations. This approach is followed by the UK and the Basel Committee on Banking Supervision itself in the latest principles published. The trade-offs that I analyzed, I'm basically focusing on three policy objectives. First, promoting financial stability. Second, promoting a level playing field. And thirdly, the orderly transition to a greener economy. So what would happen with each one of these approaches with respect or regarding to each one of the policy objectives? Regarding financial stability, well, the promotional approach has this problem that the data availability is not there yet. So we will have a fragmentation in terms of what banks do. And additionally, even if banks are really exposed to these risks, this type of approach, the promotional approach, will probably not be that effective in tackling and managing and mitigating these type of risks, because there's no certainty of what financial institutions will need to do. So we will have a problem very similar to what we witnessed before the global financial crisis with the internal risk-based models in the financial sector, but in terms of climate risk. The Pillar 1 approach, the first group in the quantitative approach, will have a conceptual problem itself, because the problem is that capital requirements are designed, those are part of the Pillar 1, are designed for short-term risks. So if we use them for long-term risks, such as climate change scenarios of 10, 20, 50 years, we will have a conceptual problem. That harms the credibility of capital requirements in general, and regarding the other policy objectives, also creates fragmentation, but most importantly, will impact emerging economies and will impact financial inclusion in certain jurisdictions. As this Xichen was mentioning this morning, what happens is that, for example, in Asia, this is going to be especially relevant if we consider that more than only 6%, according to the last report published by MAS, only 6% of economic activities are considered green under the international standards and some of these standards that the world has been discussing. So that is going to be a problem if we implement particularly this type of approach, the Pillar 1. Also, and to finalize this analysis, the Pillar 2 group, the group that is implementing this quantitative approach, will have also some problems in terms of the three, or trade-offs in terms of the three policy objectives in terms of financial stability. It is not necessarily the best tool to tackle systemic risk and manage the risk associated with this type of problem if we are talking about exposures to climate change risks. Okay. Also, fragmentation in this type of approach that is not promoting a level playing field, and additionally, is not necessarily going to contribute to an orderly transition to a greener economy.
So I do apologize, Nydia, but thank you very much. And I just want to see if you want to wrap up in a couple of sentences, and then we can move on for some questions as well.
Will do.
Thank you.
Will do. Just to finalize, after the trade-offs, I propose some solutions to kind of have a better approach in terms of prudential regulation to the transition to a greener economy. And those proposals are enhancing the role of the Basel Committee on Banking Supervision and keep promoting the consultations with the industry and other regulators, which encourage international cooperation, of course. Also implementing a regulatory sandbox for environmental related risk analysis on a cross-border level, but also on a national level. Also implementing open finance and open data initiatives for climate change. For example, there's a platform called OS Climate that tries to share, using open APIs and open data, open source code, different technological tools that allow different authorities and the banking sector to share risks and information and more data about the risks associated with climate change.
Thank you very much, Nydia, for that presentation. I'm sure everyone has a few questions, so keep them in store. The next presentation now will be our last but not least, will be from our joint presentation by Professor Li and Dr. Tian. Professor Li and Dr. Tian, please.
Hello, first, thank you very much for providing us an opportunity to attend this conference. And today, the topic we're going to share with colleagues here is a smart contract, central bank digital currency, and programmable money. And we will use China's recent practice as an example. In our presentation, basically, we will cover 4 issues. Part 1, we will look at provide overview about the recent application of digital RMB and in China. Secondly, we will look at some new form of smart contract import programmable payment system in China. And thirdly, we will look at the implication, particularly focusing on consumer protection, both opportunity, obstacles, and will be looked at. Finally, we will provide some suggestion for future law and policy reform. When we talk about the central bank digital currency, as the data provided by the IMF and in February this year, now we have more than 100 countries exploring the central bank digital currency at different level. Some folks are still at the research and testing stage, and some already and put the central bank digital currency into practice, already issue the central bank digital currency and to the general public. For example, China. If you look at history, we can see the whole process in China start from the end of 2019. At that time, and the first round, about 4 cities has been involved. And also the central bank digital currency also have been used for the Winter Olympic game. In November 2020, another 6 major cities has been joined. Shanghai is one of them. Based on the data provided by the central bank in China, which is the People's Bank of China. And by the end of last year, the number of pilot scenario for the digital RMB already reached 8 million. And the total 260 million digital wallet for the digital RMB has been opened by the commercial banks. And when we talk about the total transaction of digital RMB, this amount has already reached almost 88 billion RMB, which is about 12.6 billion US dollars. When we talk about the central bank currency and in China, and some key features include, and first, and like most of central bank currency, and ECNY, or we call it digital RMB, is designated to enrich the forms of legal tenders. And also basically it has been used to replace and the coin and the paper notes and in circulations. But unlike Bitcoin style cryptocurrency and digital currency and digital central bank currency in China is not centralized currency. It's also not based on blockchain technology. Nevertheless, it's still digital currency, so it can perfectly work with a blockchain smart contract and be used as a programmable money. As a consequence, and certainly also can take advantage and from some strong feature of a blockchain smart contract in relation to the security and other aspects. When the reason we write this paper is because we mainly found actually, although there's a rich academic literature focusing on the benefit and risk of central bank currency in general, and fewer study particularly focus on how to use blockchain smart contract to facilitate application of central bank currency as a programmable money. So in our paper, we made focus on try to explore both benefit and the risk of using smart contract import digital RMB as a programmable money. And also we will explore the potential legal implication behind that. And now we can see many legal implications involve consumer law and insolvency law and antitrust law. But for the purpose of this paper, we will focus on consumer protection in particular. In relation to the general feature of the digital RMB, we can see as a major player, the central bank is basically the authority to issue the digital RMB. But when we talk about the implementation distributor, the main distributor actually is a state-owned commercial bank. For commercial banks, they play a very important role in relation to the deploy smart contract and also distribute the open the digital RMB wallet and also distribute the digital RMB. And certainly end user include both public consumer and enterprise. The next, I will just give, I have 3 showcase or 3 real example and already and in the real world and in relation to how now the bank is using smart contract to facilitate the application of a digital RMB. Limited by the first one is dealing with education market. Limited by time, I will particularly focus on the second and third. The second showcase actually is mainly is arrangement between the Shenzhen government and the Agriculture Bank of China. So they work together and build a platform as mainly for facilitate the transaction between the tenant and the landlord in the real estate market. So basically, and after signing a tenancy agreement, and on this platform, and the tenant can pay the deposit and the rent through the platform, certainly with digital RMB. And the money will be transferred and from the tenant digital wallet and to the landlord digital wallet. At the same time, smart contract will be created and deployed to facilitate the flowing of the money. How it works, for example, if the tenant, they want to get some discount about the rental they have to pay and to the landlord, so they may decide, for example, they pay 6 months rental one-off and to the landlord discount digital wallet. But what that will provide kind of guarantee for the landlord, they will know actually the tenant have a capability to afford 6 months rental. But the risk for the tenant will be just like, how about the landlord suddenly suspend the service? So the smart contract will make sure the money in the landlord's digital wallet will be frozen. It will be released every month after the landlord provides the renting service to the tenant. So in that case, that will provide kind of a legal guarantee for the tenant. Even the landlord and breach the contract, and the tenant will still have a possibility to get the money back immediately. That's the first example. And the second example is also another example, also one of my favorite. And this one have 6 parties involved. It's mainly dealing with is in the electricity industry. It's also related to the climate change and energy saving. So basically, that's a program, they call it a solar incentive program. So basically in that program is as a user, if they want to be part of a solar incentive program, they can launch an application to the government. Once have been approved, the government will provide subsidies and for them and to purchase PV equipment, leasing, purchase the PV equipment from the PV equipment leasing company. Once the digital RMB has been transferred and from the government or from the user and to the leasing company, the leasing company will set up a transfer and also set up the PV equipment and for the user. Once all these PV equipment and in place start to generate electricity, what will happen is the electricity will be transferred to the power company. The smart contract, how the smart contract work in this context, once the power company receive the electricity and the smart contract will just make sure actually the digital RMB will be transferred from digital wallet from the power company to the digital wallet of the user. But when the money has been received, has been transferred to the digital wallet of a user, the user cannot use it directly. Why? Again, by the digital wallet and smart contract, basically smart contract will make sure and part of the money they receive from the power company will be transferred from the user to the digital wallet of the PV equipment leasing company. And after that, the remaining income will belong to the user. And that part, the remaining income will be defrozen, and then the user can use them immediately. So we can see that's the example, just like how the smart contract being used to facilitate the little bit complicated transaction among multi-parties. Next, I will pass to my colleague to talk about the legal implication and the possible suggestion.
Okay, many thanks to the organizers of the conference. It's my turn to continue part 3. We are focused on the implications of the digital RMB with smart contracts to consumer protections. The programmable money may provide many opportunities. First is safety. Digital RMB in China is China's legal tender, which is the safest asset in China. The digital RMB operation system is highly secure, highly usable, and highly scalable and concurrent, which can ensure business continuity. Second is convenience. Digital RMB is adaptive to various online and offline payments. Third is inclusive. The digital RMB loosely coupled with bank accounts. The applicant for digital RMB does not need a banking account. And this is very good news for those people who don't have any banking account. The fourth one is programmability. The programmability of digital RMB could be realized by deploying smart contracts without impeding its legal tender functions. Under the premise of security and compliance, this feature enables self-executing payments according to predefined conditions or terms agreed between two parties, as to facilitate business model innovation. Meantime, using digital RMB with smart contracts to protect consumers have some obstacles. The first one is technological risk. The typical case is DAO. DAO case shows the technology of blockchain smart contracts also have some loopholes. Secondly, there are some legal risks, such as gaps in existing laws. Next, please, next slide. Next, we'll talk about some practical suggestions. Generally speaking, we'd better have a right attitude towards digital RMB with smart contracts. First, do not overstate the capability of blockchain smart contract technology. Blockchain is a type of decentralized digital ledger, and a smart contract is a computer program. Blockchain smart contracts have their own advantages. At the same time, they also have their own limits. They can't solve all the problems. Second, blockchain smart contract is not a sole solution. In some other situations, some methods can resolve the problem too. Thirdly, we should consider whether the application of digital RMB with smart contracts are new appearance of old problems. In different applications, the transaction structure may or may not be changed, so we should analyze the different nature. We'll also give at least 3 suggestions for further law and reform. Firstly, law and the People's Bank of China should be revised to recognize the digital RMB. Secondly, the interim regulation on cash management should be revised to institutes to make settlements with digital RMB. Thirdly, the principle of property in cash passes with possession has been challenged and should be changed in the situation when digital RMB is controlled by a smart contract. Okay, that's all. Thank you for listening. We welcome your questions.
Now, this is the time for questions, and I would like to open the floor to both our audience in person as well as those online. We have a couple of questions coming from the online, but I'd like to take the opportunity to invite anyone in person to take the mic at the back of the room if you have any questions. Yes, please, Alessio. You can use the mic at the back so that the audience can hear you as well. Thank you, Alessio.
One to Robert, that is also connected to the last speakers, because my own fear in listening your talk is that we are one of the risks of this technological advance is like to have a gamification of social life. And so the question becomes, what can be the risk of how will then dynamically change the meaning of fundamental rights, for example, in a gamified society and enforcement of the law? Maybe
happy to grab that. Totally agree with this concern, and that's linked to my concerns as expressed about the limitations of a reductive data approach to people. People are much more complex than the data we might associate with them, and there's big dangers from a rights perspective in going down this pathway. Julie Cohen's wrote really well on this back in 2019. And it's been lots of other commentary about these sorts of issues. So basically I'm saying I agree with you. I can see though lots of gamification coming through. And so it's a real concern because I think we as people, we tend to gamify our lives. And so we can get ourselves into gamified spaces really easily, and we have to be very careful about that. This does not require just a legal response. This is actually more of a cultural and an ethical response that we need to take responsibility for, as well as, more significantly, the people who design systems. Those are the people I'm really concerned about because they push us down some of these pathways, and they should be held more accountable for the consumer and citizen impacts beyond the consumer impacts. Thank you.
So perhaps I could, Alessio, you have a follow-up to your question.
Maybe one for Nydia.
Yes,
so
please.
To be democratic in asking question. So Nydia, thanks again for your interesting paper. I think that any regulatory approach you may pick up among the two you show us may have like spillover, as a spillover, the fact that polluting industry will probably face a credit crunch like. And these I also have not only implication for the business itself, but for society as well. I think as, for example, what will be the employability chances of many people that maybe lose jobs working in polluting industry because they lack the expertise of the skills to be reemployed. And yeah, and this may also, and this is connected to the order transition aspects, whereas related to financial stability, as an implication then of the credit crunch towards these industries, there might be also a dangerous feedback loop for financial stability purposes, no? Creating like domino effect risk and so a perfect storm for a future financial crisis and so on, as an intended effect of the transition policy. So should we, and second question to you, should we also find a role for economic policy and not only financial regulation to push the green transition?
Thank you, Alessio. And perhaps I could invite George and Xichen to address the questions from Alessio and Rob first, and then I'll invite Nydia to address Alessio's second question. George and Xichen, you could unmute yourself. Yes.
Okay. So actually, may I actually I want to start to comment from actually the first question a little bit actually, because when I'm doing the research, actually I also realized one thing actually in relation to the one issue we have to address, which we call it all familiar with digital divide, digital gap. On the one hand, and we're using all the digital currency and we're using all the fintech to facilitate the public's life. On the other hand, we found actually the more technology we use, the more gap we will create it between the layperson and also sometimes we can technology advanced young generation. So that also not only brings the legal issue, also bring lots of social issue, access to justice. Another project I have been working on, for example, during the pandemic, and lots of social welfare agency, for example, in Australia, Centrelink, they create digital ID, digital identity. And you want to facilitate people to get access, to get a rebate, get a payment from enjoy the benefit of the social welfare system. But problem is, if you got digital ID, you can get the government payment, normally just within 2 weeks. But if you physically visit Centrelink, the whole application process can be very complicated, very long. It will take you 2 months to get the payment. So in that case, we can see on the one hand, the digitalization facilitated public access and to the existing resources of the society. But on the other hand, it's also create kind of inequality. For example, actually, particularly for the weak group, for the old generation. We found actually old generation, they have worked hard for the country for decades, but now they retired. But they have to face up all the new technology. And in most of cases, they even don't know how to use them. So as a possible resolution, actually, I noticed the Digital Transformation Agency in Australia, even include New South Wales, they set up a principle to say, when you provide only digital resolution, whatever for finance and or for the climate change, you also always need to make sure at the same time you also provide traditional paper resolution. Make sure public always can get access to the facility service equally. The principle is important, but one of my concern is, and also I think the question for not on question is common for everyone, but for the solution is, in reality, it's so hard to achieve this. For example, Use digital ID, you can get the repayment in 2 weeks. But without digital ID, and you have to get repayment in 2 months. And how can we fill in the gap? It's a very challenging question. And thank you for the question. Yeah.
Thank you, George. So I'm hearing it's a transitional journey, and I think there are obvious challenges to growing up and growing into a more digitized world. We can't leave everybody behind. I think that's a general theme across this, whether talking about sustainability or digitization. Nydia has a point about developing economies going into the next stage. So we're all growing in a sense. So whether it's the teaching old people how to use technology, or teaching or trying to have standards which would apply not equally, but at least coherently to both developed and developing economies. And Nydia, that brings me to the question to you. Maybe you have some thoughts on that.
Thanks, Wangho. First, and I will connect the answer to what you just said to what Alessio asked before. I wouldn't be able to say with the data available that we have right now whether the implementation of that direction of changing capital requirements, particularly Pillar 1, toward penalizing the investment or the exposure in brown assets, and that impact in terms of financial stability, I wouldn't be able to assess that impact right now with the data that we have available. But that's a potential consequence. And the reality of that type of policy is the unintended consequences. So my point in the transition is that in order to build a coherent transition, and a transition at least in which we are aware of those unintended consequences and those new risks that we are creating, we need more data sharing type of initiatives, more open source technology that allows authorities on a cross-border level and financial institutions to understand better those new exposures in terms of risks associated with climate change, and also more international collaboration beyond that what is happening right now. So all the policies and all the recommendations in my paper are working toward that type of transition that we need before thinking about policy or changes in the way we approach capital requirements, which I don't advocate, as you already could tell based on the presentation. In terms of the differences between emerging economies and development and the ones that are more developed, this is something that is a reality and has been a reality for everything in most topics associated to prudential regulation in banking, because we have the international standards, international setting bodies saying something about this. So this will necessarily create those consequences no matter what type of economy we're talking about. And we want that type of standardization. We want comparability. That's something desirable in order to mitigate systemic risk on a global level. So that is something that needs to happen anyway. But the important thing is to be aware of those consequences, because if we need to also work in certain jurisdictions toward financial inclusion, for example, we will need to implement other tools apart or besides capital requirements and prudential regulation to mitigate systemic risk in order to work towards those other regulatory goals that are also important for other economies.
Thank you, Nydia. And Rob, yes.
Just a few very brief comments backing off what Nydia has said, but also speaking back to the judge's challenge to us at the beginning of the day. And so to try to integrate that with some of the things I made reference to, it strikes me that there certainly is a need, as Nydia is saying, for us to be very clear about what is the policy we're trying to achieve and why, and what are the different dimensions that impacts, and therefore at the outset, set up those pieces of design. And this is where maybe academic thinking is useful to inform regulators and business co-designing a system to address a human need through a design thinking approach, so that we start gathering the data at the beginning to track how we're going with the progress of the initiative, instead of, as is happening now with the consumer data right, retrofitting some of that data gathering at towards the end. Or rather, there was data gathering, but it was all quant, and it was only one aspect of the problem. So looking at the qualitative measures, the human measures that we need to bring to the table to understand whether we've got proper sustainability. So this is where I think really productive dialogue can be had between business, government, and academia to help improve the design of policy and tracking whether policy is hitting measures.
Thank you, Rob. I've got a question from the audience, and I think this is probably the last question before we wrap up, but it ties, I think, everything together, and that's my question to Rob. We're talking about data flows and talking about different uses of data because we're trying to regulate something with different factors and consideration in different circumstances. So I wonder if this point has factored into your research, and that is the role of the RCEP, the trade treaty, regarding cross-border data flow, including those concerning private and public digital currencies. Question is, does that RCEP approach leave too much room to each state in terms of data flows? And
well, what struck me looking at RCEP, and I had course to do this because it was part of a capacity building program that DFAT funded into one of the ASEAN states. I won't say which one, but earlier this year, back in April. So we're doing some capacity building improvement around e-commerce. So the chapter 12 of RCEP. And looking at that, and as I said before, there are some measures there. They only have to bring in 5 and 10 years for certain countries because of their status of development. On the other hand, what struck me was so much of RCEP is just basic 1996 UNSW. Yeah. And so in a sense, it sort of surprises me that we're still talking about e-commerce because a lot of it should all just be commerce, right? A lot of it is electronic, but as George said, not everything is electronic. So we're in this in-between transitional state that you spoke to. So I actually don't think that we're giving people too much room to play. I think a bit of play is good. And what struck me listening to the government officials from this jurisdiction was that they said they weren't really happy about how they had some foreign experts drop in and say, here's how to do it, right? So we do need to help people down that path, but not from the sense of just leading them by the hand, but helping them work out what is the best pathway for their culture, their country. And I think Nydia's also written about this in some of her papers about the need for that variability. So yes, we need a degree of harmonization and consistency, but no, I don't think everyone has to be doing everything the same at the same time.
that's right. I think that's part of Deborah's presentation as well. I think we take some stuff and borrow and look at reflections from, for example, Australia looking at Singapore competition law, recognizing the differences, but also looking at how we can look better. And that's part of George's and Xichen's study as well, because this is obviously a case study of the CBDC in China. It was an 88 billion digital RMB. That's staggering from just, given that it was only started, very recently, this pilot. So that takes me really to the end of this panel. I mean, lots of discussions to follow. There's an academic panel number 2 coming up in about 15 minutes time. We started a bit late, so we do apologize for the slight delay in ending. But any questions from the audience, please feel free to reach out to our panelists, whether in person or online. I think we'll be sure to welcome your comments. So we'll be back in 15 minutes time. For the people in Singapore, it is 3:30 p.m. or 3:35 p.m. For those in Sydney, it's 5:35 p.m. Thank you very much for your attention, everybody.